This is FRM Part 1, Book 4, Valuation and Risk Models, and the chapter on operational risk. Just a quick review of what a bank does in terms of its operations. Remember that banks essentially do two things. They accept deposits and they make loans. So think about operational risk in the following manner, that difference between the left hand and the right hand side of the balance sheet. Over on the right-hand side of the balance sheet, you have all of the liabilities and equities. So you have the deposits and you have the bond issues and the equity issues. Those are the sources of capital. So banks take all that, throw it over to the left-hand side of the balance sheet, and they make loans. And so what do the banks do? They make loans to homeowners and students and car owners and businesses, et cetera, et cetera. So the loan portfolio makes up the asset base of a financial institution, but remember, banks also own things like buildings and land and software and all sorts of other stuff. And so this operational risk is really the management of what goes on inside of the balance sheet. And then, of course, that is summarized. Those operating activities are summarized over on the income statement. And I think these learning objectives reflect my little summary there. So we're going to compare three approaches to calculating regulatory capital. So that's going to be the stuff on the bottom right-hand side of the balance sheet. And then we'll talk about the Basel Committee. And we'll do some distributions. Of course, almost every chapter we talk about distributions. And then scenario analysis, which is always one of my favorite things to teach my students. And then we'll take a look at some control issues and key risk indicators. And then we'll end up with a brief conversation on some insurance stuff. So let's go ahead and get started. Let's compare those three approaches for calculating regulatory capital. All right, so remember, we've got to go back all the way to the early 1970s. And this Basel Committee, which essentially was formed, I think there were, 25 or 27, different countries involved. And so this was really trying to provide an industry, a global wide, kind of a sense of direction for banks. And that first committee was pretty much focused on default and credit risk. And then the second committee was formed somewhere in the late 80s after the 1987 stock market crash, I think, maybe the early 90s. And then the last one, of course, was after the 2008 financial crisis, which we spent a lot of time, many chapters ago, talking about. And so what this committee has done is defined operating risk. Now, remember, I kind of gave you a big picture item in that first slide. So here's the definition: the risk of direct and indirect loss resulting from inadequate or failed internal processes, people, systems, or from external events. Includes legal risk, but it ignores reputational risk and strategic risk, mostly because it's really difficult to measure reputation or the strategy. Remember, the strategy comes from upper management and the board of directors primarily. This reputational issue is really kind of interesting. It's difficult to measure. I'm guessing you guys know there's a well-known large financial institution that had some problems, in the last couple of years. And boy, you can't watch a sporting event these days without this financial institution coming on and trying to manage its reputation and reestablish its strength. And the commercials, I think, are pretty clever, and they're probably pretty effective. Anyway, so three approaches to protect against these kinds of operational risk losses. And so we'll go ahead and talk about those three in the next couple of slides. Notice my little cloud point over there. Part 2 focuses on these concepts. So we'll start with an introduction now, and then we'll really get into kind of the meat and potatoes, so to speak, later on. All right, the basic indicator approach is probably exactly what you would come up with if you had to decide how can I determine how much capital I need to protect against these operational losses? I mean, think about what goes on the right-hand side of the balance sheet. Let's suppose that you take in $800 in deposits and you issue $100 in bonds and $100 in shares of stock. So you have $1,000. And so all of the people over here on the left-hand side of the balance sheet are waiting to take that $1,000 and do something with it, right? Because the bondholders and the shareholders, they demand a return. So the bondholders and the shareholders are saying, do something really, really good with our capital. And as a bank, the only thing that you know to do is to make loans. So you make loans and you do all sorts of credit analysis and all that kind of good stuff. And then you realize that some of those people, they are either going to be unwilling or unable to repay the interest or the principal on those loans. So you need some kind of a buffer, some kind of a capital requirement. So clearly $1,000 isn't going to work, because then you're not going to be able to meet the interest and the dividend payments to the bondholders and the shareholders. $0 is probably not going to work, because you have lots of these depositors who are going to show up the next day and say, hey, I want my money back. And so the question then becomes, how do you just determine how much? 0 is not a good number, right? And $1,000 is not a good number. So somewhere in the middle. And of course, the governing bodies, these influential professional organizations, have decided that 15% of annual gross income sounds like a good number. Whenever I hear someone say, oh, it has to be this number here, I always think, why not 16%, or why not 14%? We had this big conversation in the United States about the reduction in the corporate tax rate. It used to be 35%. Should we drop it to 21? Should we drop it to 19? What's the right number? And it's almost impossible to come up with the right number. Although from your basic economics classes, marginal cost and marginal benefits, you could probably try to come up with a number. So anyway, we have 15%. That's what we're going to live with. And here's a quick example. So if we've had our net income over the past 3 years of 150, 200, and 300, then why don't we just sum those and divide by 3, multiply by that 15%, and we get some estimate for the capital required to protect against operational risk. So basic indicator approach, that's pretty simple stuff. Well, let's make it a little bit more complex. Let's call this one the standardized approach. And in order to do this, we need to classify the bank's activities into a bunch of standardized activities, things that almost all banks do. So if you look down that left-hand column, all banks don't do all of these things, but of course the larger banks, they do. And what we're going to do is weight each of those business lines by a sensitivity factor, or it's known as a beta factor. And so all the stuff that you know about beta from regression analysis or from the study of systematic risk for equity securities, all that stuff applies here. And these are standard numbers here, the 18s, the 12s, and the 15s. Those are kind of determined by, go back to this one over here, right? There's 15. I think if you do all the adding there and divide by the 8, you get somewhere around 15. So anyway, what you do is you take the gross income for each of those business lines and then multiply it by the beta factor. And then you sum those, and that gives you your capital. So back here we did this 32, and you could get 32 million out of this example here if you created the right numbers. Now, in order to use this standardized approach, there are several requirements, and so these things all sound an awful lot like control mechanisms. If you take statistics or operations or supply chain as an undergraduate, you learn about all these quality control systems like Six Sigma or Lean or all that kind of stuff. And so look at these requirements here. An operational risk management function tasked with identifying, assessing, monitoring, and controlling of operating risk. Keep records, regular reports, well document, and then, go over there and say to somebody who's a professional, hey, come on in and see if we're doing it the right way. So independent reviews by by people inside the financial institution and outside the financial institution. And so that probably makes sense. If I swing back here to this table, it makes sense then to have good quality control measures inside of each of those business lines, so that when we sum these numbers and we get something like, what was that, 32 million or something from the previous slide, that we're confident that that is representative of our business. Now, how about the AMA approach, this advanced measurement approach? What we're going to do is we're going to kind of leapfrog from what we did in the previous slide with the standardized approach. So there we have the same table there, but what we're going to do is we're going to have 7 categories of operational risk, and they're listed right there, and I'll talk about them in just a little bit here in a future slide. But notice what's happening here, and so just think of this in terms of a matrix. That first table over there, we're just going to go down, right? But now we're going to go across, and then we're going to go down. So we've got 7 categories of operational risks. So we have 8 business lines, and so these are 56 potential sources of operational risk for a bank. Now, when you're going like this and then going like this, you might think to yourselves, and hopefully all of our studies together would lead you to suggest, boy, going like this and going like this, that sounds an awful like stuff that we've talked about in the past. Let's do some kind of value at risk measurement. And of course, my last block point down there at the bottom suggests, some use of the value at risk. So there we have, almost 100% value at risk for each combination, and then you can go like this to measure them. Here is a description of those 7 categories. They're pretty self-explanatory, right? Internal, external fraud, business practices, safety, damage to physical assets, business disruption, execution, and delivery. So this makes sense about what I was referring to in the very first slide. Think about all the stuff that goes on in managing the asset base for a financial institution, and then think about what can go wrong on that side. And so that's pretty much a summary, those 7 categories of operational risk. All right, how about loss frequency and loss severity? And so these are 2 concepts that are important. We want to ask the question, how often are we losing money? Let's just use that term now. Are we losing $1 million every day? Well, that doesn't sound like it's very efficient. Or are we making money every day, and then every 5th day we're losing $1 billion? All right, so loss frequency and loss severity. These are 2 important concepts. The reading refers to them as dimensions, right? So loss frequency is defined as the number of losses incurred over a specified time period, like a week or a month or a year. Now, what we need to do is ask ourselves the question, all right, so frequency, that sounds like we can summarize this in a distribution. And so what do we know about this? Let's suppose that we want to say, all right, how often does it occur that a particular group of homeowners misses their monthly mortgage payment? Well, remember that, these loans are made during the course of the year, and they can be due at any date. I remember when I refinanced my mortgage, the mortgage broker said, what day of the month would you like to repay your mortgage? And I said, wow, I get to choose. Boy, what a great idea for me to pick which day of the month I want my mortgage payment. So, boy, wow, this sounds like free enterprise and capitalism and democracy all sewed up into one decision. And of course, for me, it didn't really matter. So I think I picked the 15th. But anyway, so let's suppose that we know the average time between events, but those events actually occur randomly. So we know that on average, something bad is going to happen or something good is going to happen every 10 minutes or every 7 days or every 3 months, whatever that is. But those things occur randomly. Well, this is the Poisson distribution, which was developed by a dude, I think his name was Simeon Poisson, back in I'm going to pick a year, maybe 1825 or 1835, somewhere around there. Anyway, back in 1825, I mean, there really were no things like computer systems for financial institutions, but I'm sure there was a financial institution that benefited from this back in the old days. All right, so notice what I have in that circle point there. So the distribution assumes that the losses occur singly, right? So you can't have multiple ones at the same time, and they are random. All right, so there's this Poisson distribution probability there, the probability of n losses in t years, which is given by, we've got t years right there. So there's the capital T, and then we have the n losses, and then we have that lambda thing in there. And that is going to be the mean. So this is what we know. This is what I said. We know the mean number of losses or mean number of whatever we're trying to measure. And so there's a quick example that it's going to be 2. So there's loss frequency, and we can use that Poisson distribution to help us. Severity, on the other hand, is the size of the loss. So loss severity and loss frequency are independent, and the severity can be analyzed using the log normal distribution. So back here we're using Poisson, here we're using the log normal distribution. And of course the fascinating thing about this is with all of these computer systems and algorithms that we can use, the Monte Carlo simulation really is going to play a big role in here. So we can use to determine the exact distribution of the expected loss and the loss severity. Then we can combine those things into a Monte Carlo simulation. And so that's what I have in those little graphs here. There's loss frequency, there's loss severity, and then we can use Monte Carlo to come up with that aggregate loss. And that sounds an awful lot like, hey, this is going to end up with some value at risk measure or some kind of a measure of the combination of these two dimensions, so that we can give ourselves some kind of an estimate of all the bad news that might happen in the next time period, whatever that time period is. Now, of course, we're not going to do this perfectly. We're never going to be able to say, you know what, next week on Thursday, we're going to lose $6 million. Can't do that. So inadequate historical records, inflation, firm-specific adjustments are required. So these are going to be inaccuracies and biases in the estimation of loss frequency and those severities. And then, of course, the distributions are probably going to be at least somewhat biased. And so we need to make a scale adjustment, because if we are using industry data or data that is externally generated, we need to make sure that we can adjust it so that it fits the terms here. Let me go back here quickly, a couple of slides. It fits our business lines so that we can make those adjustments where I am there. So we're going to do some kind of an adjustment. Here's what I talked about in that first slide. I love teaching my students about scenario analysis. And of course, the great example of that is going back to your very first economics class and your very first finance class, and maybe your very first accounting class, when the professor said something like this. Hey, here's the current state of the economy. Let's suppose that we want to try to figure out what's going to happen in 6 months' time. And so the professor said, hey, let's suppose we have an expanding economy, and let's suppose we have a contracting economy. And the expanding economy has an 80% chance of occurring, and the contracting economy has a 20% chance of occurring. There's scenario analysis. So the two scenarios are probability weighted of an expansion and a contraction. And then you can try to figure out whatever those variables are for the outputs. Now, of course, we've spent lots of time talking about decision trees. So instead of just having two branches, you can break this up into shorter time periods, or you can break it up into more scenarios. And you could say we have a 4% chance of having a super expanding economy, and then all the way down. All right, so you have all of these branches coming out, and then you can have all the nodes, and you can do all that stuff for a decision tree. But of course, the great thing about this is that those branches may or may not have occurred in the past. And this is important. Think about what we're doing. We're worried about low frequency, high severity losses. I mean, this is what occurred in the 2008 financial crisis. Low frequency, high severity losses. This can completely wipe out a bank. And then we talked about the contagion effect. So if it completely wipes out one bank, then you have another bank, and then et cetera, et cetera. Now, back in your economics classes, you just said something like, okay, here we have the expansion, here we have the contraction, because, this is pretty much what economies do. But for scenario analyses that are relevant for individual financial institutions, we need to worry about the firm's own historical experience, and then how our experience relates to our other competitors out there. We need to get advice from market analysts and consultants. And of course, the board of directors and our senior executives are going to be critical in determining which scenarios are relevant, which scenarios are not. And then, of course, the Basel Committee was very much in favor of scenario analysis. And so just envision a gigantic Excel spreadsheet moving out like that with all sorts of macros written in there for the different kinds of scenarios. How about causal relationships and some control and key indicators? When my son came home from his second year of college back in May, I said to him, hey, what did you learn this year in your business classes? And he said, correlation does not equal causation. And I was like, that's great. Paying tens of thousands of dollars for that summation, but it's actually a really, really important one. So causal relationships describe this search for a correlation between firm actions and operational risks. But we've got to be careful and make certain that even if we find correlation, that there is also causation. I mean, clearly, if we have somebody out there in our financial institution who is embezzling capital, and that's contributing to our losses because we can't find the source, well, then there's a relationship there. But just because we have one doesn't mean we have the other. And so what we're trying to do is identify firm-specific practices that can be linked to the history, right? I mean, it's important to figure out why we had those losses in the past, but it's even more important to figure out, if we've had those losses in the past because of these reasons here, then we need to fix them going forward. All right, how about risk and control self-assessment? All right, so what we're doing is we're going to ask the departmental managers to single out the operational risks in their jurisdiction. And so this is important stuff. I mean, of course, these are the individuals or groups of individuals who, pretty much know what their line is in their department. And so they're going to know what should be the focus point inside of that business unit. And then more importantly, making sure that the information flows from below and that information flows up above, so that this process can become efficient and effective. How about some key risk indicators here? These are firm-specific conditions, so staff turnover, vacant positions, failed transactions, et cetera, et cetera. So the idea is that these KRIs are going to identify potential problems so that, once again, we can fix them before those losses occur. How about a scorecard, right? You guys know I like to give sports analogies all the time. And so, at the end of a golf tournament, if you can add, right, you can add up your strokes, you figure out who the winner is. So we need some kind of a scorecard here. So let's go ahead and use return on capital employed. And so that's going to be a great measure to compare a unit's performance relative to another. What that means then is that we can use individual units' performance in comparisons to others. And then going back to, let me go back here real quick, going back to these key risk indicators, going back to self-assessment, going back to, let me go back even, where am I going? Going back to all of these 7 categories, what we're going to do, and let me quickly go ahead. So now we have this scorecard so that we can kind of decide why it is that we made those good decisions or how we incurred those losses. And let me go ahead and continue with my golf analogy. Those of you who are golf fans or those of you who watch golf on TV will know that there are tons and tons of statistics like strokes gained on the green or strokes gained from the tee to the green. And so, clearly this final score is the most important one, but these golfers can go in and say, all right, do I need to be better off the tee? Do I need to be better in the fairway? Do I need to be better around the greens, or do I need to be better on the greens? And so that's what this return on capital employed. It's going to give us extra information so that we can make these better decisions, so we can have better risk management. Of course, should make perfect sense. There's this simple power law that's going to help us determine some probabilities. So let's suppose that we're interested in determining the probability of a random variable exceeding some value. All right, boy, that sounds an awful lot like value at risk. There's the power of law. It's a simple but a powerful tool. And to illustrate it, let's just go ahead and quickly work through an example. We've established a 95% probability that losses over the next year will not exceed 50 million. All right, but that doesn't mean that we could have loss. That doesn't mean that we can't have losses of 70 million. But what does it mean if we want to know about losses that are 10 million or 30 million or 41 million or even 1 million? All right, so given this power law parameter of 0.7, what's the probability of the loss exceeding 20 million, right? 20 million is between 0 and that 95% probability of the 50 million. So we can use this power law, and we get, what is that? Somewhere around 10%. How about if we use insurance to lessen or mitigate these operational risks? Let me tell you another quick golf story here, and this will give you kind of an indication of the moral hazard and the adverse selection that are some problems with insurance. Years ago, I was at a scramble golf tournament, and the guy who was running it, and it was a run to benefit a local private school, and so it was a fundraiser, kind of a charitable fundraiser. And this guy who ran it was offering $500 for a hole-in-one. And so, sure enough, there was a golfer who wasn't very good. It got up on this tee. It was a very short par 3, maybe 120 yards. And this dude, he sculled one, and it went down the left-hand side of the fairway, and it sliced around and went up and went right into the hole-in-one. And so the guy was mad about it. Everyone was so excited. The guy was mad about it because he didn't take out an insurance policy. A hole-in-one occurs, 1 out of every 10,000 shots or something like that. And an insurance policy might have cost him, $20 or some number. And so I was fascinated by the decision of when to get insurance and when not to get insurance. And so financial institutions, of course, they can buy insurance to protect themselves against, things like fire and theft, but they can also buy insurance to protect against things like, embezzlement or a rogue trader out there who's, hiding in the corner office and, executing billions of dollars worth of currency swaps. All right, so this insurance is available, not for all of the operating risk managements, but for many of them. But when insurance is used, there are 2 problems. There's this idea of moral hazard. So if the company knows that it is protected against a particular event, it might increasingly take high risk positions because it knows that if it fails, then the insurance company is going to come in and pay those losses. And that's why insurance companies have things like deductibles and coinsurance and et cetera, et cetera. And then there's this idea of adverse selection, and this can be summarized by thinking of whenever you trade with someone else, whether it's on the floor of the New York Stock Exchange or if you're buying a used lawnmower, right? Do both buyer and seller have the same information set? And the answer is almost no, always, right? And so adverse selection means that you have this risk of trading with somebody who has more information than you do, right? So if you buy this used riding lawnmower and it doesn't have an engine in it, well, the person who's selling it to you is going to try to mask the idea that there's not an engine in there and try to sell it to you at the highest price. And of course, this happens all over the place with adverse selection and insurance. And so insurance companies, they go to great lengths to prevent people from buying insurance on the day before they know they're going to need it. And I think that takes us through the chapter.